Okay, good morning and happy Friday, everyone, and welcome back to our Friday morning market outlook session. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and we have a lot to unpack with you, so let's go ahead and get started. Now, before I do, a quick disclaimer: what we're going to discuss here today is purely for educational and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So today we're going to start off with our usual market update, looking at the broader markets, the major indices, and talking about where we currently see some concentration risk, because the health of the market rally, which is something that we've discussed week after week, is starting to turn around and deteriorate. And we want to show you where that deterioration is happening, and then also taking a look at some of the details here within the FAANG stocks. So today we're actually going to break down all of the 5 FAANG stocks, where they currently sit, because this is really where a lot of the outperformance of the market is currently sitting. It is dragging the rest of the market, I wouldn't say higher, but certainly stable. And so we want to take a look at the health of those 5 stocks. But we'll put them into the context of the earnings calendar, take a look at some of the COVID trends and unemployment trends that I wanted to point out that are, from the headlines, may sound good, but actually are worsening. And lastly, I want to show you some of the ideas that we have here for the current market. So let's go ahead and get started. And the question that I want to try to answer for a lot of investors as we get questions over the past few weeks is really what's driving this market. We see a spike in COVID-19 cases. We see unemployment starting to come down. We see mobility trends starting to improve. So what's actually driving all of this? So we want to try to answer that here today. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. Let's go ahead and get started. So if we first talk about the S&P 500, the question I think on most investors' minds is really, can we get a breakout? We've been talking about this 317, 318 level for a couple of weeks now. It's been rejected at that level. We had that island top, this bit of an exhaustion top, if you will, that's generally speaking used as a topping formation. But markets continue to make higher lows and continues to push higher. Yesterday's price action was actually surprisingly strong. We sold off all the way down to the 310 level and then rallied all the way back up to 314 in the afternoon. That is a very strong price action. So the question is whether or not we're going to get the breakout here to the upside. And to help answer that question, we should take a look at some of the other markets, because as markets continue to push higher, momentum actually continues to move sideways. As you can see, money flow is quite weak on these subsequent moves higher, both on the daily and weekly chart. That is concerning for markets as they continue to try to push above that 317 level. As of right now, we don't see a lot of evidence that suggests that markets are going to break out. But if we do manage to break out above that 317 level, that could put us potentially much higher here into that 339 February high. Now, looking at the NASDAQ 100 index, this is the first step to look at in terms of outperformance. The NASDAQ 100 index is the only major index that still continues to make higher highs. But as we told you over the past couple of weeks, each time it's made a higher high, momentum has not confirmed those moves highs. And we've seen a significant decline in money flow as markets continue to move higher. That is concerning. Also, on the weekly chart, as markets continue to move higher, momentum has not confirmed that. So you have this major negative divergence. The further this negative divergence goes, the more likely you have a pullback that's generally sharp and violent. This in itself, one thing I do want to point out, as I've said before, the negative divergence that you see it in itself does not signify that you're going to get a reversal. It just simply means that you have a higher probability of reversal, and the longer it goes on for, the more likely, the more violent those types of sell-offs tend to be. But the catalyst that actually breaks the camel's back, that's yet to be seen. We do have earnings season coming up. That could be a potential catalyst, but more likely something outside of that. And those are some of the things we're going to discuss here today. Another thing that I wanted to add to this that we haven't looked at prior, which is the FAANG Index. So this is a New York Stock Exchange index. You can actually trade futures and index options on this index. This is basically 10 equal weight FAANG plus, it's called the FAANG plus index. It basically has 10, it's an equal weight index that has 10 relatively high momentum mega cap tech stocks. And as you can see over the past couple of weeks, it really has started to accelerate to the upside. And this is kind of a bit of an exaggerated, if you will, concentrated index, similar to the NASDAQ 100 index. And we're seeing this continuation higher, going almost parabolic, both on the daily and weekly chart. And we see the same concerns here. We have that major negative divergence that has happened for weeks on end now. And momentum continues to no longer confirm these moves higher. So again, this is concerning for this group of the market that predominantly is dragging the markets higher. And actually the broader market is actually declining. And it's really these few concentrated stocks that are keeping the markets afloat. If you're looking at the S&P 500, if you're looking at the Dow, it's really these few concentrated mega cap names that has continued to keep these indices flat, while the rest of the market is actually declining. And this is something that we've been talking about, is the health of the rally. Is this market rally healthy? And for the most part, from the March to roughly June rallies, markets were participating. The broader market is participating, so the health of that market was strong. But over the past few weeks, this has really started to decline. And we were saying that the small caps and equal weight indices were starting to lag behind, but over the past few days, they've actually started to reverse lower. This is concerning when you see concentration in such a few names and the broader market declining. This is sort of what we started to see going into that February high. January and February of 2020, we were seeing these types of market action. Again, what broke the camel's back was COVID-19. Now, we don't expect that to happen necessarily again, but there is some kind of black swan event like that is likely what's going to be driving the next wave lower. As far as what that is, almost impossible to predict, but it's important to have this information to know that it is time to start thinking about potentially looking at preparing for put options, buying puts, if and when that decline starts to materialize. So small caps started to decline as markets continue to move higher here. We've talked about the decline in momentum here in small caps for the past few weeks. Money flow remains weak on both the daily and weekly chart. Same thing on the equal weight index. The equal weight S&P 500 index starting to reverse lower as the S&P 500 continues to push towards that relative high recently. Money flow looks very weak as well. So we're seeing the same price action here, both on small caps and equal weight, which is not particularly healthy. VIX also continuing to see a small uptick here. So we've had almost what looks like almost like an inverted head and shoulders here on the VIX. Now, I generally don't like to apply technical analysis on derived data such as the VIX. The VIX itself is not an asset, it's not a tradable asset, so we generally don't use a lot of technical analysis on this, but it is remaining above 30, and what's concerning is that it made a higher low, meaning that markets are continuing to expect future volatility to be elevated. So the question at this point, though, is whether when you have this elevated volatility, which generally speaking favors selling option premiums, do you still continue to sell options premiums as volatility remains high, even though markets trade at near relative highs? And that is a really good question, and it's hard to answer because you could easily see a very huge spike here in VIX, and that certainly would not be good for option sellers. So this is something that we are paying attention to very closely, is the stability of VIX. As of right now, it still is fairly stable, but a single spike here would lead us to believe that it's starting to not favor selling options despite the high implied volatility, because volatility is starting to see an uptick. So this is concerning to us. Gold continues to grind its way higher. We talked about the breakout from 164. It broke out, came back to retest this as support, and continues to move higher. And if we look at long-term, gold looks like a strong breakout here on this 164 breakout is likely going to continue higher. This is the flight to safety that we're currently seeing from investors that are concerned about this market and where it's currently trading. We're seeing that flight to safety in gold. We're seeing a slight sell-off here in oil. We've talked about this $41 level for quite some time as resistance. We talked about it on Tuesday. We were concerned that it was going to get rejected at that level. It did. XLE is down almost 5% yesterday as a result of this. Any type of, our base case is still the belief that oil is going to pull back rather than break out above that level. And we're starting to see that in the energy sector. One thing I did want to point out here is that, again, this flight to safety, TLT, starting to rally. So TLT, for the most part, had this move down to the decline, to the downside. You had a bit of a resistance here around 165, but recently broke out above it. You had confirmation on the momentum. You have confirmation on money flow. And this is all supportive of this flight to safety. So investors clearly are concerned about what's currently happening in the markets and the concentration that we're seeing. We're seeing this flight into gold, into bonds, perhaps away from equities. We're starting to see that outflow out of equities. Now, I will say that this type of outflow in equities typically is considered as a contrarian bullish indicator. So when you see investors pulling out of equities, that's usually an inverse contrarian indicator. So that is one of the things to look out for. So I do want to point out some of the COVID-19 trends. So we've been talking about this, that despite the number of new cases, the number of deaths in the US continue to move lower, but we have seen this uptick over the past few days that is concerning here. This recent uptick, usually lags the number of cases by 2 to 3 weeks. We obviously know that we continue to push new cases, 63,000 new cases yesterday, which is a new all-time high. That is concerning that this is going to continue to reverse. And one of the things that I want to point you to is the fact that we've been talking about unemployment numbers looking fairly strong. Many of the rallies we've seen in the market over the past couple of months have been on the back of strong employment numbers. Now, one of the things I wanted to point out is that if you look at the unemployment claims, the blue line, the blue shaded area are the state unemployment numbers. This is the one that's been declining. This is the number that the headlines have been paying attention to in terms of the number of unemployed, in terms of the number of jobs that are added. The concern about this is that if you look at the state numbers, the numbers look like there is about 18 million unemployed, which is significantly less than the 32 that we typically think of in terms of the unemployment. And where does that come from? Where does the difference between 18 and 32 come from? That's 14 million unemployed. It really comes down to the federal government's unemployment assistance, the $600 a week that the federal government is providing. And the difference here is the fact that if you're receiving the federal benefits and not the state benefits, you don't necessarily have to report that you're looking for work. So these are people that are not necessarily counted as unemployed, but they actually are unemployed, and they're actually on fairly limited unemployment claims from the federal government, which is expected to expire at the end of July. Now, we do expect the federal government to continue this. However, we certainly expect the second package to be smaller. We certainly expect that second package to have a tougher time getting through Congress than the first one. So the question really becomes, can there be bipartisan support for the continuation of this unemployment for federal claims? And this is predominantly for jobs that were not did not qualify for unemployment under the state unemployment insurance. So for example, if you are a bartender and you are making minimum wage and bars are all closed, you do not actually qualify for the state unemployment, especially if you were being paid cash. So these people are currently being covered under that federal unemployment claims. And the question is whether or not these 14 or so roughly million claims are going to be able to continue to get that assistance. And as you can see, also that number has actually increased over the past month and a half or so, while the state unemployment has actually started to decrease. So there is a bit of disparity here, and sometimes the headlines are sometimes misleading in terms of saying that there's 18 million unemployed from the claims from states and unemployment is declining, but in reality it's actually increasing here due to that federal aid. So that is really some of the, I would say, black swan events that we're paying attention to for the federal government in terms of how they're going to enact a second round of stimulus, and whether there's going to be bipartisan support, and how clean and how easy is it going to be passed. The less clean that is, the more fighting there is between the parties to pass this, the more likely that markets are going to react negatively to that news. So those are some of the things that we want to point you to. The only good news that we continue to see out of the markets really comes from consumer confidence. Consumer confidence can go a long way in terms of driving this market. So that is one of the things that we continue to see is driving this market right now is consumer confidence. Consumers surprisingly remaining, well, I wouldn't say surprisingly, consumers are still remaining very strong. However, most of that strength comes from the fact that between the stimulus money, tax refunds, this has actually pumped more income, discretionary income, into the system than prior to COVID-19. And that's why we see consumer discretionary be one of the strongest sectors at the moment. But again, that is likely going to taper off, especially with 32 million unemployed. The question is just really where does it start to taper off? And that tapering off is not going to necessarily happen instantly. It's going to happen relatively slowly. So this is the concerns that we see going more likely into Q3, at the end of Q3, going into Q4 rather than Q2, because right now we're focused more so on the earnings season. So this kicks off in full gear next week. We do have a special event next Thursday at 4:15 for those of you that want to join us. We're going to be talking about the earnings season. We're going to do a preview. I'll send you the link into the chat window for those of you that have not signed up for this event next Thursday, where we're going to talk about the earnings season. We'll talk about some of the early reports, which actually have been surprisingly strong. So we expect Q2 earnings to actually be a fairly strong earnings season here for the markets. And as far as how markets are going to react, that's the question. But we do expect that the bar right now is the consensus, and the bar has been set very, very low. And we do expect that most companies, or a majority of companies, are going to beat their earnings estimates. The question, though, again, is how are markets going to react, and what type of forward guidance are they going to be providing? Because Q2 is going to be the worst of the quarters, and we expect Q3 to recover, but the question is the speed of that recovery is actually what markets are looking for. So there's been a lot of guidance that's been pulled out of the markets. We'll have to see if companies are going to provide some more guidance here going into the Q2 earnings, and that is something that's likely going to be driving markets here over the next few weeks. So a lot coming up in the earnings season. Next week is predominantly going to be the major banks, a couple of small airlines. We also have a couple of pharmaceuticals and some technology companies like Netflix. But for the most part, it's going to be banks dominating the reports next week. Banks always gives us a good indication of the earnings season coming up, or the health of the economy going into the earnings season. So very important event. I hope that you'll be able to join me here next week. So what I wanted to do is, since we've talked about this huge concentration that we're seeing in the markets in these FAANG stocks, or these high momentum stocks, rather mega cap technology stocks, what I wanted to do is break down each of the stocks and see how these stocks currently look from a technical perspective. And some of them are a little worrying. So let's first take a look at Facebook. So FAANG, Facebook, Apple, Amazon, Netflix, Google. Those are the 5 stocks we're going to take a look at. So first of all, Facebook broke out above this 220 level back here in late May or so. And it's managed to, for the most part, consolidate for quite some time above that May, and recently started to push higher above that short-term consolidation. So after the breaking above that 220 level, it's consolidated, like I said, for quite some time between this level, and recently pushed to the downside and came back to retest this and broke out to the upside. So the question is whether or not this breakout is sustainable. And if we look at the momentum indicators, you have this relatively continuation higher, but notice how the momentum indicators actually did not confirm each subsequent rally. Money flow is relatively stable here, so that in itself doesn't tell us much, but the fact that as markets continue to push higher, momentum does not confirm that. That is concerning. That shows us that this could possibly be a false breakout here on Facebook. So first stock we're looking at, not particularly strong. Apple, Apple does remain relatively strong here, but one of the things that is concerning for us is the fact that as Apple continues to move higher, same thing, momentum has not confirmed those moves higher. That doesn't mean that Apple can't continue to move higher. It very well could, but the further it goes, the more likely that you have a strong, violent pullback here. Money flow also looking very weak here on Apple, which is something to be concerning if you're investing in Apple. Now, premiums here are really high, so if you're selling cover calls, these are the types of strategies that you want to utilize in this type of market environment if you own stocks like Apple. Amazon is one of the ones that look out of the five looks the strongest from a relative strength perspective, but momentum is starting to get quite overcooked here. But as you can see, each subsequent move to the upside, momentum actually has confirmed those moves, but it is at this point overbought. Money flow relatively stable, moving a little bit lower, but momentum confirming the moves higher. So Amazon out of the five looking the strongest actually here. And if you look at the business model of Amazon, it makes some sense that during COVID-19, you have a huge amount of small business and local businesses closing. So the retail business of Amazon has done very well during this time. They've expanded out into a lot of other industries such as groceries, which also has been a huge tailwind for them during COVID-19. Their cloud businesses actually has likely going to see an increase in business, especially as businesses shift from working from offices to working from home. Microsoft Azure and Amazon are the two dominant players in this particular space. So fundamentally, it makes sense why Amazon is actually strong in this current market environment, especially out of the five. So Amazon really also partially dragging this index higher out of the FAANG Index. Netflix, relatively strong. What I noticed here in Netflix is what started to look like it was going to be a head and shoulders formation here. Looks like it was going to break out to the downside, but instead Netflix did something very different. It broke out, tested as support, and continued to move higher. Now, Netflix also, again, fundamentally makes sense why this stock is still strong, especially as you have a new spike in COVID-19 cases and locking down and staying at home and staying in and social distancing is likely going to stay for a while. Not only that, momentum and money flow strong here. So this is confirming this breakout here on Netflix. How much higher can it go? That's hard to say because Netflix is starting to reach that overbought territory. Every time it reaches that territory, it does tend to pull back a bit, so we might see that as well. But at least what that confirms for us, though, is that this breakout here is not a false breakout, that this is what we would consider a true breakout here. So Netflix likely to be one of the stronger, probably the second strongest stock here out of the FAANG Index. And then let's look at Google, or Alphabet rather. So this is really where Alphabet is at a pretty pivotal moment here. We know that ad revenues is on the decline, especially for 2020. But markets are somewhat forward-looking, and we have this massive double top here around this 1500, 1520 level or so, both on the daily and weekly chart. Now, one thing you might point out here is as markets reach that double top, momentum is not confirming that. You have quite a bit of negative divergence on both momentum and money flow. As markets continue to move higher here, momentum did actually confirm this last push higher here because momentum did make a higher high, but money flow looking fairly weak here. So Alphabet here at a pretty pivotal moment here. The question is whether or not it can break out to an all-time high here, but chances are you might see a short-term pullback before it can rally above that level. But Google least overbought here out of all of them and could potentially push higher here above this 1520 level here on Alphabet. So, that covers what I wanted to show you guys with as far as the FAANG stocks. As I said, this is the sector of the market that has been leading everything higher. And as you can see, predominantly around technology and consumer discretionary, there are some cracks showing in the system as far as these five stocks go. Amazon being the strongest, the rest of the three not looking as strong with the exception of maybe Netflix. So what I did want to show you is some other ideas that we came up with, or which is trends that we're currently seeing emerging in the markets, one of which is aerospace. And this applies across the board, whether you're looking at Lockheed Martin, Northrop, Boeing, General Dynamics, even some of the airlines. You have this softening trend here where, as you can see on the weekly chart, what looks like almost like a head and shoulders type formation here for Lockheed Martin, and yesterday finally broke out below that neckline. So this could potentially bring us substantially lower here on names like Lockheed Martin. And again, Lockheed Martin was the one that I think the chart looks the cleanest. You had that clean breakdown below that support level and is likely going to go back and revisit perhaps down to this 280 level. So we're seeing this trend across the aerospace industry, momentum confirming these new lows, money flow looking particularly weak, both on the weekly and the daily chart. So this is something that we are concerned about in terms of this area of the market. And if you're looking for shorting opportunities, these are the types of names that I would start picking through. Costco, retail comps are starting to accelerate, as we saw here in Costco yesterday, and that's why Costco continues to rally here. Costco is at a fairly pivotal moment, similar to that alphabet chart. You have this massive double top. There are some concerns about this from a momentum perspective. As you can see, as it reached that double top, momentum did not confirm that move higher. So it might stall here at that double top, but the daily momentum did confirm it, but reached overbought. So you might see a bit of a pullback here. Money flow wasn't particularly strong, but is certainly improving here over the short run. So those are some of the trends that we want to pay attention to, because if Costco can break out above this 325 level, especially if it maybe pulls back, then starts to break out, or if it breaks out, pulls back to that support and continues to move higher, you could see Costco start breaking out above that 320. Most of the analysts price targets for Costco is substantially higher in the 350, 370 level. So you could get that move higher here, especially if it can confirm that breakout above 325. So retail, certainly one place to look at. You have a similar chart in Walmart. You have similar charts in a lot of the retail stocks. We did have some negative movements in stocks like Kroger this week. But these are some of the names that are likely going to still continue to do well as long as COVID-19 cases continue to accelerate. Clorox also accelerating to the upside, breaking up to that 230 level. Again, my preference is to always wait for a pullback here before going long, especially in names that are starting to reach these overbought. But we're seeing a lot of these names reach these overbought conditions, and that's why we're throwing caution to the wind with respect to continuing to push longs. Okay, so with that, that's what I wanted to cover with you guys here today. I just want to thank everyone again for our members to support us, to allow us to continue to do this. If you have not signed up for if you don't have access to OptionsPlay yet, you can sign up for a free 30-day trial at OptionsPlay.com. And for those of you that are on your trial, or if your trial is just expiring, you can sign up for membership just at trade.optionsplay.com/member to continue having access to this type of research and reports for your daily trading. So with that, thank you so much. I do have a couple of minutes here before the markets open up. So if you have any questions, I'm happy to try to answer any questions. I do see one question about Southwest Airlines and whether or not we're going to stay in that position. Southwest Airlines, like I said, with the whole aerospace industry not looking particularly strong, I do think it's time to start cutting losses here on that particular trade. Neela is asking for Square thoughts. Square has been consistently strong here. I'll be perfectly honest, I don't understand the strength here as much, considering the exposure they have to small businesses. Now, one thing I will say, momentum has confirmed those moves higher, but as you can see, money flow looking particularly weak here. The weekly chart also confirming this move higher, actually, which is also surprising. So Square looking surprisingly strong, but very, very overbought both on daily and weekly charts. So I think you have a high probability, I believe, of at least a small pullback here before it can continue moving higher. NVIDIA is one of the ones that I actually quite like from a semiconductor space. The daily chart looking fairly strong, momentum confirming those moves higher, money flow not looking particularly weak. So NVIDIA is certainly one of the stronger ones. Airlines, AAL. American Airlines really not looking very strong. I know a lot of investors are looking at these levels and saying, is it time to start buying? If you look at the travel data, it is predominantly in leisure travel. There's no corporate travel at all, which is why I still prefer, if you're going to look at the airlines, look at the domestic discount airlines, JetBlue, Southwest. Those are the two, I would say, prime candidates in the domestic discount space. Versus the legacy United American and Delta Airlines. Can you look at Shopify? Should Shopify be added to the FAANG stocks? So Shopify, I think from a market cap perspective, is still pretty small compared to the FAANG Index stocks. So I don't necessarily believe so. You know, Shopify remaining relatively strong, but somewhat of the same concerns now is that momentum is no longer confirming those moves high. Money flow does remain very strong. So Shopify is one of those stocks that is going to continue to likely see gains because as consumers shift their spending from physical stores to online. Shopify has a very large market share of processing payments for the online space. So with that, markets are about to open here. It looks like we're opening up flat here again. Again, we're kind of just stuck here between this 318 and 310 level. Yesterday's price action was particularly strong, so let's keep an eye out for where we go. So Tuesday morning, we'll come back. We'll do this again. We'll probably look at the overall sectors. We haven't looked at the sectors over for a while here, but looks like all sectors here opening up higher with the exception of energy, technology and communications. Maybe we're starting to see some of that cracks here in the technology sector here as all other sectors open relatively in the green, but technology opening up lower. NDX actually, the NASDAQ 100 index actually opening lower than the S&P 500, something we haven't seen here in a while. So with that, thank you so much. I hope you guys find this useful. I hope you guys have a great Friday. Happy trading, and I'll see you guys next week.